Hexaware, backed by Carlyle Group, is all set to make its debut on Dalal Street once again. The company is looking to raise 8,750 crores via an IPO. The price band has been set at 674 to 708, which pegs the company's market capitalization at a little more than 43,000 crore rupees. You're watching IPO KYC. I'm Reema Tendulkar, and today joining me is the top management of Hexaware to talk about the way forward and the company's IPO prospects. Let me welcome Shri Krishna, CEO of Hexaware Technology, and Vikash Kumar Jain, the CFO of the company. Well, Hexaware has had a very rich history. It was incorporated as Aptech in 1992 by Atul Nishar. In 1997, it went public. In 2002, it underwent a rebranding and it was known as Hexaware. In 2013, the company saw a significant shift when Barings Private Equity took over. In 2020, it got delisted. In 2021, a year later, Carlyle took over as the promoters, and now here we are in 2025, early 2025. We're talking about Hexaware's second coming on Dalal Street. Gentlemen, thank you very much for joining in. So, Keech, let me start with you. Well, you've always been one of the faster growing mid-cap IT companies. Now your revenue growth over the last 2 or 3 years has been about 13.7%. Now that we're seeing an uptick in the IT industry, are you confident about maintaining this growth run rate?
First of all, good to see you again, Reema. Listen, we have a strong history for a number of years of doing better than the industry. Okay, so that's all I'll say. And we feel good about a number of things we've built in the company that are built to last, that we think will keep us on a good performance for a very long time.
So you're confident about outpacing the industry even going ahead?
That's what we've done in the past.
Okay, and what's your expectation of industry performance in calendar year 25?
I don't think the industry is going to tick up in growth materially. 24 was, I don't know, maybe 4.5%. We get a little bit better percentage.
So we're talking about high single digits. Can we push to, at least for the industry, low double digits?
No, I don't think the industry will get a double digits anytime soon.
So mid to high single digits?
I think so, yes.
But for you, at least you're confident about double digit?
We've done quite a bit better in the past. So, and I feel good that there's no reason for us not to sustain that outperformance.
Okay. So let me put it in another way. Are you confident for you this year is going to be better than the last year, given the environment?
That's the hope. It's still our fiscal year and calendar year are the same. So we just started the year. It's been less than or just over a month, and elections have created quite a bit of discontinuity. But in general, the discontinuity is one of positivity. Right? Okay. There's expectation that this year will be better in general for the macro.
Okay, better for the macro, better for the industry, and perhaps better for Hexaware as well?
It's in that sequence. If it's better for the macro, it's going to be better for the industry and for us.
Vikash, let me come to you on margins. Margins for the company have come down a little bit in the last 2.5 years. What is the outlook on margins?
I put it this way, that margins have come down from the pre-COVID era, and primarily because of the fact that the margins at that point of time were unsustainable because a lot of the costs were not into the P&L. Visa expenses, travel, utilities. Coming back, we knew that those costs are going to come to play. If you look into our margins on an adjusted basis, our margins have been steadily improving, and that's driven by a lot of operational efficiencies that we have put into motion. Our utilizations are improving, attrition rates are coming down, our offshore mix are improving. So we feel very confident in terms of our current levels of margins and maintaining that.
Okay, so sustaining margins. But forget the adjusted margins because they are adjusted for ESOP costs. So currently margins are about 15.2, 15.3% in terms of the EBITDA margins. That's the run rate which should sustain. And what's the reason for the drop? It's just COVID era margins were higher than usual.
No, one of the reasons was, one was the COVID era, the margins were higher than the usual. The other aspect was in the year 21, we saw that the 21-22, we saw that there was a significant uptick in demand. And at that point of time, we made a conscious call in terms of going for the market share gain, not leave the market share for short-term margin pressures. And at that point of time, we also had to pay competitively in terms of retaining and attracting talent because the attrition rates were very high. So those were the reasons, and those were specific investments that we made to build our long-term business, which has actually helped, if you say, in terms of delivering growth, which has been much faster than from an industry perspective. On the margins, the adjustments that we did are truly one-time in nature, and that's why we presented an adjusted view. So we would say that our adjusted margins, what we have reported, are the ones which are the baseline for us.
That's the baseline. And is there scope to expand margins?
Well, the operational improvements are in play. We expect that the operational improvement will continue, but we'll see how it plays out. We feel very confident about the current levels.
Confident about current levels. Keech, while you've been higher than the industry now, some of your peers have grown faster than you. Just to name, say, a Persistent from the RHP. Coforge has been doing very well. What, according to you, is the reason why some of your peers have done better than you?
First thing I'll say is that we've done better than the vast majority of the industry, and we've done it for a very long time. Of the two names you mentioned, one is certainly doing better. Other, I think there are some ups and downs. There are quarters when you do better, and there are quarters when they do better. But what is true is this, that there is always an opportunity for us to do better. And we are always looking for what can we do to do better. We put some strategies out. Look at specific white spaces, geographic, service line, vertical capabilities. So we are always thinking about what can we do more to grow faster.
And can you outline the strategy in terms of white spaces, or geographical expansion?
I'll give you one example. Okay, we built this platform called RapidX. RapidX, we think, is the best enterprise-grade software engineering platform. There's a lot of talk in the industry that GenAI is going to reduce the need for software development. And that's very focused on one narrow aspect of software development, which is coding. But actually, coding is only 20% of a full software development life cycle. RapidX solves for the entire 100% of a software development life cycle, not just the coding, which is what everybody speaks about. We think, as an example, RapidX will open material new sets of opportunities for us in legacy modernization, in forward engineering. So that's an example of a capability we've invested in, which we think will accelerate growth for us.
Okay, that's in capability. But in terms of geographical expansion, you refer to it?
So the two markets that I think we have an opportunity to do more, if you look at global macros, right, the two economies, large economies that are decoupled from global macros, Middle East and India. And we think both these are markets that we can do better in.
And what is your current contribution from Middle East and India?
It's marginal.
Okay,
It's very small.
Very small. Low single digits, like sub 5?
In percentage terms, not much lower. I mean, it's like 25 million or so, or thereabouts in revenue.
So even if it grows, even if it doubles in size, it's not going to be material to move the needle.
Unless it doubles for several years continuously.
And you see that kind of an opportunity?
We think there's an opportunity to become bigger in Middle East.
Okay. One of your strategies, which seems to have played out, is broadening your client base or growth beyond the top few clients. And you've struggled a bit, especially on your top 2 clients. So first, talk to us about why your top 5 clients have underperformed the company growth rates.
I'll say kind of 2 things. One, that the way we report this, the top 5 clients are constant. So it's a constant period. If somebody grows really fast, it's a new list now, right? So it's growing slowly for a period of time is a precondition to somebody who's doing better to get into that list. So actually there are clients that are doing really well that have got into the top 5, okay, or will get into the top 5 in future. I think the second thing is important for companies of our size. Client concentration is a big issue. Anytime we have a major client going through a downturn, it could lead to a dip in performance. We managed over a period of time to systematically focus on and reduce that client concentration risk. Right now, our top 5 clients is just over 25% of revenue, which has come down materially from what it used to be in the past. So I think it's a good thing for us that we've managed to reduce our client concentration.
What was it in the past? The top 5?
3 years ago, it was 30%.
30%. Now down to 25%. And you want to bring it down lower?
Little bit.
Little bit.
Yeah.
What's a comfortable level?
I think, 30, or it used to be even higher in the past. That was uncomfortable. Okay. We are in reasonable comfort zone now, but a little bit reduction is not a bad idea.
A little bit. I think your top 2 clients are, government mortgage companies in the United States, and they've struggled a bit over the last couple of quarters. And now again, we're talking about the possibility of no Fed rate cuts going forward, which would have otherwise benefited them. What's the outlook on these 2 particular clients of yours?
So we've named one of them the RHP Fannie Mae. So I could speak to Fannie Mae, what their business is and what we do for them, right? They are in the business of keeping the liquidity engine, the US economy going. So they're not actually the ones that are selling mortgages directly. They are underwriting rules and pricing rules for other companies that sell mortgages. So they're one step removed from the ups and down cycles of the mortgage industry.
Any of your clients facing any challenges? Any specific clients? Headwinds?
None, which is, if there would have been anything meaningful or material, we would have disclosed it into our risk factors. So if you look into our risk factors, there has been no mention of anything which is not in the normal course of business.
Do you see any headwinds as you look out in this year?
Macros, potentially. Our client specific, no.
What about Europe, auto? It's a bit downbeat, the sentiment there.
So we don't have a significant exposure to the auto industry.
Okay. And any other sectors where you see any kind of pressure?
If there are broad-based tariffs, it can impact a lot of sectors.
Okay.
Of course, auto, you mentioned the initial tariffs against Canada and Mexico would have impacted the auto industry the worst. Fortunately, we don't have too much exposure there.
Health and insurance is a large sector for you, the second largest after BFS. And growth this year in 9 months of calendar year 24 and the prior year was lower than the company average growth. What was the reason for that?
I think there was a lot of growth that happened in this sector. COVID, a little bit post-COVID, for vaccines and new drug discovery. And it came off that highs quite a bit. And I think it's on the path to recovery, but it did come off those highs quite a bit.
Got that.
I'll just add to that. The fact that we are present in 6 different verticals and we service 6 different industries actually helps us, which basically means that when some of those industries are going through their cyclical ups and downs, we are better managed because we are not overexposed to any one industry. And that's the reason why you see our growth rate significantly ahead of the industry growth rate across a period of time, because we are very broad-based in terms of the industries that we serve.
So strategically, do you want to make any changes to the kind of vertical contribution that you have?
Not necessarily. We did make one important change, that we felt banking was underrepresented in our portfolio. So 3 years ago, we formed banking as a separate vertical.
Got it.
It did not exist before that.
Okay. And now it's about 28.3% of your top line.
Banking? No, it's
Banking.
about 8 or 9% of our top line. Financial services.
Financial services is?
Financial services, 28%.
Okay.
Banking was embedded within financial services, and we thought it was not getting enough focus, so we separated the 2 businesses out.
Got it. And now you're comfortable with the current rate?
Yes.
Tell us about your acquisition strategies. There was a recent one, Softcritic, which you made in May of 2024, a data consulting firm. And prior to that, there was one 5 years back called Mobiquity. So what's been the acquisition strategy of Hexaware since we last spoke in the 5 years back?
So think about AI, it is foundational is data for that. And I think all the big focus right now is on data engineering. Look at growth of Snowflake or Databricks and companies like that, right? But I think the focus is going to shift pretty quickly from engineering to what do you do with the data once you got it to cloud. And an important such area is customer and marketing analytics, which is what Softcrylic is really good at. And that's the reason why we acquired them. And that's also reflective of our broader acquisition strategy, which is to focus on capability acquisition.
Are you looking for more acquisitions? Are you scouting for more?
We have the best cash flow conversion in the industry. We generate lots of capital.
So what's the cash in the books now?
End of September, we had close to $140 million in terms of the cash.
Okay. So, and are you scouting for acquisitions?
We have an active M&A program.
And dividend? The company has been very active in repaying the dividend. What is the dividend policy?
So if you look into as we said, our cash flow generations are very high. Last 3 years, we have paid out close to more than 50% of our profits in the form of dividend. But is there scope to up the dividend policy from the current 50%? Or this is not a well-defined policy as of now? No, it takes into consideration multiple aspects. It takes into consideration what's been our performance, what are the internal factors, whether there is going to be a need in terms of deploying back that capital back into the business versus giving it out to the shareholders. So the board takes into consideration all these factors and will decide. But there is not a percentage which has been called out from a policy perspective.
Numbers are healthy. I think last year it was about 17.5 rupees, and the year prior to that it was close to about 22 rupees in terms of a dividend that you paid out to the shareholders. Carlyle, you've seen two PEs come in. I mean, Barings came in, went out. Now you've got Carlyle in. They're bringing their stake down from 95 to about 75%. So at least they're meeting the minimum public shareholding norms for now. But what is the strategy of Carlyle? We know they don't stay forever.
You got that right. I mean, they won't stay forever. I mean, you've seen PE firms holding, how Baring was with us, how Baring was with Coforge. I think you should expect a similar pathway.
But have they laid out how long they want to stay invested? Is it like a 10-year journey for for Carlyle?
Both the funds from which they invested in us and our investment are still fairly new, just over 3 years old. So there's plenty of runway. There's no kind of set timetable. There's no set timetable. There's plenty of life left in the fund. There are two different funds.
There are two different funds. Yeah. But on a ballpark, 10, 15 years is the fund life?
I don't know. But we were like in year 3, year 4. So there's enough time left for the funds.
But shareholders would be worried, right? Because they've seen in the past, when private equity players own the company, there is a steady supply which keeps coming in, sort of capping shareholder returns.
See, when we decided to go public again, one of the most important decisions was where we go public. And really the choice was between US and India. And I think there are many positives of India, but the biggest thing that we convince ourselves is the liquidity. The amount of liquidity in the market is so high that we don't think that, a stake such as ours being sold to the market is going to create any impact on the market.
If you have to look in the future, do you think once again, whenever Carlyle decides to exit, it will be sold to another promoter entity? It could be PE, or do you think it will go down the Coforge path without a promoter entity? But as you said, there is ample liquidity in the market. As and when promoter stake sales come in, it will be absorbed by the market, and the management continues.
The plan is to become a purely public company.
On the likes of Coforge?
Yes.
Okay, and this is a plan which you all have discussed, and that's the reason why you selected India, because as they sell their shares here, it will get absorbed.
I mean, what I saw was 2 odd billion of new liquidity per month when we started the process, and now it's already at 3 odd billion a month. It's a lot of new liquidity every month for anyone to sell down.
So Keech, you've been now in the company for 10 years as a CEO. You joined in 2014. 2 years back, your revenue crossed the $1 billion mark. You're closer to 1.3, 1.4 if you annualize last year's numbers as and when they come. When do you think you'll get to $2 billion?
We're not even necessarily thinking about 2. It's
so what are you thinking about?
You're thinking about 3.
Oh, you're thinking about 3. And how soon can we get to 3?
Well, we're working hard to get there. It's like a race. The distance in a marathon doesn't change.
It's the preparation.
26.2 miles.
Yeah, but it's the preparation and training. So tell us the roadmap, the blueprint to get for $2-3 billion for Hexaware.
So I think, what are the things that we feel very good about the fundamentals in our business? We think we have a great leadership team, very talented, very ambitious. A lot of people in the leadership team are like me and Vikash, who worked in big companies. They built big businesses. And there's a lot of confidence we can replicate that in Hexaware. And we've done some of that already, but we think we can replicate that more. Two, as a consequence of that, we built outstanding capabilities, right? And each capability is now underpinned by a platform. And I gave you an example of one platform, the newest one, RapidX. We have Tensai, we have Amaze, which is patented. So every business is underpinned by a solid platform. Our hunting capabilities have become really predictable. Every month we will get new logos. And what has not changed is that we have the highest NPS score in the industry. We always deliver outstanding work to our customers. So what does the combination of all this mean? That we have great client base. So at this point, 62% of our revenues comes from large customers, customers whose revenue is about $5 billion. So this is a flywheel, this is an engine. I think this is the set of foundations that we think will keep us going.
So to get from 1.2, 1.3 to $3 billion of a top line, is M&A going to be an integral part or not needed?
M&A will be a part. Okay, M&A will be, we generate capital, so we'll be smart about how we deploy that capital.
Gentlemen, thank you very much. It's been a great conversation, Keech and Vikash. Thank you once again for speaking to CNBC-TV18. I look forward to more conversations.
Thank you.
Thank you.